All right, good morning, everyone. Let's get started. All right, U.S. stocks had a bit of a mixed session yesterday. We saw S&P more or less totally flat. We saw the Nasdaq up about 0.25% and the Dow down about 0.4%. What we did see is a little bit of strength in the U.S. dollar after the ADP numbers yesterday, which are a little bit better than expected, plus the prior month's revision was better than expected. I actually think the revision is more important than this month because the December numbers are always kind of unreliable due to the fact that there's so much seasonal hiring and sometimes it's part-time, some of it's full-time. It's a little bit unreliable, that December data. So a little bit harder to trust. The Fed released their minutes yesterday for the December meeting. It showed that most members agree with the decision to taper stimulus due to the underlying improvement in the labor market and the likelihood of it being sustained. And they also had a bit of a tussle among the group of deciding on whether or not to potentially reduce, giving guidance that they could reduce stimulus going forward based on the unemployment rate. And they've already said that they would start to reduce it based on the unemployment rate, but they talked about kind of reiterating that and thought that might be pertinent. So I think to me it came off maybe a hair more hawkish than the initial statement. And could have possibly weighed last night on some of the selling we've seen in commodities and maybe held the market down a little bit. All right, Asia, we saw mostly mixed action. We saw Nikkei that took a bit of a beating. Not 100% sure why it got hit so hard. The yen's more or less around the same sort of levels. Nintendo is down a little bit, but nothing too significant after yesterday's move due to China. But other markets were mixed. We also had Chinese consumer and producer prices that were a little bit weaker than expected, but then you have the Chinese market, which is actually up on the back of that. So that market just kind of seems to do the opposite of what you think it'll do every day. All right, market data out today. Very little, but we do have the start of U.S. earnings seasons, with Alcoa always being the first one to kick it off. That's going to happen after the U.S. bell today, so just keep that in mind. We are getting back into earnings season. I think we could see a little bit of a period of hesitation over the next 2 or 3 trading days as we start to get into earnings season, maybe even a week before people really start to make up their mind on what's going to happen. I think it's going to be really important to gauge that first week or two this quarter to see whether or not we are going to kind of continue to outperform what the actual results are. I think expectations are a little bit higher this quarter, not as high as they will be for next quarter, but they're going to need to start to see at least an improvement in the outlook for some of these companies, I think, in order to kind of keep this rally going. All right, market data out today. We had Australian retail sales and building approvals, both better than expected. Like we said, we had the CPI and PPI numbers out of China, both light. We've got the SACCI business confidence numbers here locally at 11:30. We've got trade balance numbers in the UK at 11:30. We've got consumer confidence in the Eurozone at 12. We've got manufacturing production numbers year on year here locally at 1. We've got industrial production in Germany at 1. We've got the Bank of England bank rate at 2. We've got BOE asset purchase target same time, and then we've also got the ECB, which is going to announce interest rates. So don't expect any surprises there. But remember, in terms of interest rates, but I think it's going to be a bit more about the jargon out of Carney and the likes in the ECB. So just keep that in mind after the meeting. Just watch the European indexes closely and the euro and see where we're going to be shaping up there. And then U.S. jobless claims to finish the day in the States. All right, let's get into the maps. Keep it somewhat short today, but the first thing I wanted to have a look at this morning is the euro dollar. Again, we looked at that yesterday. We talked about some dollar strength being a real potential. Last night, interestingly enough, we saw a dollar strength come in relatively quickly. You can see there that we've kind of punched through. In my mind, we've put that little consolidation in there, kind of close to 136. We punched through 136 against the euro this as of last night, and I think that we really could continue to push higher in the dollar, obviously lower in the euro, on the back of this little breakdown in the trend line here. I really am hugely bullish the dollar this year. I think this can be a big move coming from here, probably a big move lower, and the yen as well against the dollar on the year as well. So just keep this in mind. Remember that this is one of our risk barometers that we're going to look at, is kind of these crosses, and I think that we're going to have to continue to we're going to have to adjust our expectations a little bit with euro going stronger against the dollar not necessarily being the leading indicator and being that bullish going into the next couple months of this year. All right, we're going to look at the U.S. 10-year Treasury here, which we talked about before. Kind of popped its head above this 3% yield level, and really couldn't really make a proper breakout. But the great thing is, since we got up to that 3% level, we've really just been hanging in there, either at 3 or just below 3. Call it 295, and that little consolidation to me is a bit telling. We had a nice rally into the 3% level last night, slightly backed off this morning, but I think that we're getting very close to making the punch through on 3% yields, and I think that the market's kind of screaming at us about that at the moment. I think that's one of the reasons why we're continuing to see the weakening in all the emerging market currencies. I think this is kind of the story. My fear is that the local bond yields are going to start to really run as this runs. We're at 827 right now versus 3 in the States. If we move up to 325, 330 over the next month and a half, 2 months, there's no way that our bond yields will stay the same. And the way that our currency is blowing out here at the moment, we lost 19% last year alone against the dollar, and we've already extended that in the short time that we've been in 2014. If this continues, it's going to be very negative for certain shares on our index. Obviously, some of them will see a benefit out of that, maybe some of the Rand hedge stocks, but all the rest should probably be under pressure of that. That's obviously why we're seeing this huge pressure on the retail sector. They may be starting to price in the potential of higher interest rates in the near term, because they're going to have to do something to start to stymie the inflation we're going to see out of this weak Rand. So just keep that in mind. All right. CFR really underperforming the last couple of days. Yesterday we saw it taken off of the Bank of America Merrill Lynch's most preferred list in Europe, kind of coming back down towards support around 99. I think we could find some sort of support in CFR. I think if it drops 99, then it's definitely got a little ways further to fall. We got that fake breakout here above 105, and really it's just kind of made a rip down over the last couple sessions. 99 I think could be a decent little opportunity to take a nibble there, especially because it's such a Rand hedge. Local retail, retail has been heavy obviously, but this one I don't think is going to be affected in the same way. All right, look at BGA here. I think about everybody and his brother has had this position on for the better part of 2 months. But what's interesting here, obviously we pop back up to that 135 level. We've got a little bit of an inverse head and shoulder setup coming along here, where you can see maybe that being the neckline there, kind of close to 135-ish. If we can hold 130 over the next couple sessions and start to push higher, especially if we can get above 135, then this chart actually starting to look a little bit more bullish if we get above that level. So, I would say the guys that are in it, and the reason why I'm kind of going back to this is that so many people are in it. I think if we drop 130, I think you got to get out of this thing if you're long. If we can get above 135, that may actually be an area where it's worth adding to this position. So just watch that little range closely. I think it's going to be tested in the next couple of days to break out one way or another. And then Anglos also. A little bit of a maybe an inverse head and shoulder setup, definitely not that clean looking. But if we trade down to sort of 220 and can hold, I can see the possibility of the setup. It's very congruent in terms of with the neckline here at 230. So it's not the most classic setup, but bottom line is, we're looking for looking for something interesting, and I think if we, this 220 to 230 range is key. Once we break out of that one way or another, we'll kind of know where this thing's headed next, most likely. And that's it for today, guys. Thanks a lot.